The June PPI coming in above, hotter than expected after yesterday's negative CPI print. Joining us now on the markets is Jeremy Siegel, Professor Emeritus of Finance at the University of Pennsylvania's Wharton School of Business, Chief Economist at Wisdom Tree. Jeremy, Professor, it's good to see you. You said that we won't see a rotation into small stocks and value stocks until it becomes clear the Fed's going to cut, and that the CPI, you said this before it came out, could be a game changer. That's exactly what happened. You saw what happened with the Russell yesterday. Now, what is this? 3 steps forward, 2 steps back? What did the PPI say to you?
Well, I think it's 4 steps forward and maybe 1 step back. There's a few components here that do go into the PCE, and it's going to take a little while to suss that out. But I think that the CPI was a game changer. And yeah, I mean, it was last Friday for Scott Wapner closing bell that exactly what I said. And I think the Fed should definitely cut. I mean, not only was it great inflation news on the CPI, which is far more important than the PPI, but let's look at jobless claims. Now, jobless claims were good this week, but don't forget they reported the week of July 4th, which, is always distorted. I'm really looking at it next week because we've been on an upward trend, not only on claims, we've been on an upward trend on the unemployment rate. When we hit 4.1%, we hit the so-called Psalm rule, which says that if the 3-month moving average goes up 0.5%, which it did on the last labor report, the probability of a recession is very high. Now, I'm not calling for a recession, but I'm saying that is on the Fed's radar. So I'm looking at that. I think he's teeing up a cut. I'm just hoping that he'll cut fast enough that he won't go too slow on the way down, the way we know he went far too slow on the way up. So my concern is not that he's going to, cut too much, but he might cut too slowly. But the data will tell us what the judgment is.
You don't think before September?
No, unless we get a big deterioration. I mean, I'm trying to think that July 31st is the meeting. So we get maybe 1, 2 jobless claims, no other really important indicators. So, no, he's far too deliberate. But it'll be a tee-up, I think, saying we now see the conditions in place for a cut if the data continue to move in the direction that we are seeing at the current time. Right. Of course, the cut is expected to be 25 basis points, but, there's 6 weeks until that next meeting, and we'll see whether he is compelled to do more at that time. But that's my expectation for the July 31st meeting.
So not just inflation, but suddenly what we're seeing in the labor market.
Because it looks like this half is going at less than 2%.
Yep.
We were originally excited about, last year way above expectations. The Fed expected over 2% for 2024. Well, the first half looks like under 2%, and that's below Fed target. So there's many reasons. He himself said, we're not going down to 2, waiting for the CPI to go down to 2 before we cut. That's far too late. What was really encouraging, finally, that rental component, which I've talked about so often, is so lagged in the CPI, finally started coming in lower. And hopefully that'll continue to happen in coming months to keep that CPI rate in line.
So the other mandate's now just as important. It used to be inflation. Now you got to look at both. And the claims number is one way to see it every week. The rotation we saw yesterday, does that continue? You think the NASDAQ is ready for a breather? Do you think you're going to see a move into this? The breadth will improve. Smaller company stocks will go up. Value will go up now. That was the beginning of something yesterday?
And the reason is that small firms are so much more sensitive to the short-term interest rate, which the Fed sets. You know, it used to be called LIBOR, now it's called SOFR. They pay the short rate plus 200 basis points, and all their inventories, a lot of their borrowings are due to that. A lot of the big companies, you know, either pay through equity or fixed in long rates long time ago. Those firms are going to be the most helped by lowering interest rates of the Fed, and I think that's what stock pickers saw yesterday. And, you know, unless we get, you know, some, you know, bad news to the contrary on inflation or too fast an economy, you know, it could be that yesterday marks a shift finally in the big tech stocks versus the rest of the market. I mean, I've never seen anything with 400 stocks go up in the S&P and the S&P goes down. That's something that you don't see very often, if ever.